I'm Charlotte McLeod with investingnews.com, and here today with me is Alain Corbani. He is head of mining at Montbleu Finance and manager of the Global Gold and Precious Fund. Thank you so much for being here. Always great to have you.
Thank you, Charlotte. It's always a pleasure to be with you.
Yes, I always enjoy our catch-ups. And since we are very nearly at the end of 2024, of course, we're going to spend some time looking forward at the new year. But before we go there, I wondered if we could take a quick look back at gold in 2024. Any themes that stood out to you, surprises, takeaways that you have?
So 2020, when we had this interview, the same interview a year ago, we strongly believe that gold would hit the 2,500 level, and for the fundamental reasons that we explained, and that we are going again to update the viewers today. But basically, the scenario is unchanged, and we think that there is more room for gold to hit $3,000 in 2025. But backward, 2024 was a very good year for bullion, for physical gold. It was a very good year for silver, physical silver. Less so for platinum and palladium, but this is a very different topic. And we're going to focus, unless you ask me other questions, but we're going to focus on gold and mainly gold and maybe on the side silver. So silver and gold had a great year. The disappointment came from the gold miners, and when gold, year to date, we're up 26%. The gold miners are up. If I look at the major gold miner indices, they are up 10%, 14%, 15%, 16% for the silver miners. So they underperformed the underlying commodity, and this is a disappointment. But this is year to date. But if we had stopped counting 2 months ago, this class of assets had outperformed bullion, and the main reason is the inversion of the perception in October, November, of the direction of interest rates, with our new U.S. president coming into office in January, and the statistics showing that he had significant chances to be elected president, to win those elections. The market's starting to shift, and they're starting to discount what they call the Trump trade. And that Trump trade was about more growth, more inflation, and that induced a less dovish monetary policy. And this is exactly what the market has been playing over the last 2 months. So we are in that honeymoon phase that for us is not going to last very long. And even though the Federal Reserve has been, they were in December very, very sure about their dot plots and the fact that rates would move slightly lower, but not much. And the inflation would be around 2.5%, and the growth rate for 2025 of the economy, U.S. economy, would be around 2.1%. Well, if that's the case, and we don't believe it's going to be the case, but if that's the case, rates should stabilize at these levels. And this is why we had this consolidation in the price of gold and a consolidation in gold miners.
Okay, I think that's a really good look back at 2024. And it gives us a lot of different paths to go down. I want to ask you a little bit more about the Fed in 2025, because when we had, as you said, the same conversation last year, we talked a lot about the Fed. And I remember what you had told us is when the Fed pauses, this is when we have the gold price go up. And of course, we had that pause, and now we have the Fed going down. So maybe we can hear a little bit more about what you think is coming from the Fed in 2025 and what that could mean for gold.
So we should always listen to what the Fed says and try to put those words in a context of fundamental data. So in December, let's look at what the chairman of the Fed, Jerome Powell, said in December. He said basically that we are closer to the neutral rate. And to say that we are closer to the neutral rate implies that he is not going to lower rates much more from the current levels. And this is what the market is playing. The market is positioning for very limited interest rates cuts in 2025. Actually, if you look at the statistics of the futures, what the futures are telling us is that basically they think that we will have only 125 basis point cut in 2025. So what I'm saying to those who believe in that scenario, and there are many of them believing in that scenario, is that we in an environment where you have leading indicators who are showing a weakening economy, an inverted yield curve that uninverted and now is in positive territory. Inflation, everybody's focusing on the last couple of months, the numbers of the last couple of months. But the reality is that remember that inflation was at 4.5% not long ago, less than 2 years ago. We're at 4.5%. We're down to 2% now, to 2.5%, and suddenly everybody's expecting a resurgence of inflation. There is a resilient economy, there is a resilient inflation, but it doesn't mean that the economy is not going to weaken. There are too many indications that are showing, and to start with the labor market, that are showing that demand is going to weaken. And if demand weakens, therefore growth will weaken. And if growth weakens, the Fed will have to intervene and lower rates much more aggressively than what we're discounting today.
Okay, really interesting to go into that. And if we take a look a little bit closer at the US economy, are you somebody who thinks that we're heading toward a recession, or what do you see coming in that regard?
Well, there are some, the Fed has been really focusing a lot on the labor market lately, and rightfully so. And if you look at the job openings in the US, those numbers keep slowing down. And I remind you that in 2022, that number was at 12 million job openings in 2022, and we're down to 7 million today. The 7 million, to put them in context, is back to pre-COVID numbers, statistics. And back before COVID, we were trying desperately to have a growth rate above 2%. And we had no inflation, hardly any inflation. And we believe that we're going back to that old normal, which was 2% growth and probably some inflation, but not much more, and we'll need lower rates, because today the nominal rates are at very restrictive levels. And this is what very few people understand. You cannot have a 2% growth rate and have a restrictive monetary policy. And this is where very humbly, I find it very strange that we can have nominal rates, the Fed fund rates at 4.5%, 4.25%, and inflation at 2% or 2.5%, and expect these levels to remain at this level without impacting negatively the economy. This has never been the case before. We don't think in new paradigms that will allow you to evolve with 4%, north of 4%. The 10-year US 10-year notes are trading at 4.6%, and very limited growth. Mind you, some growth, but very limited. So to be a little more concise, I will say that we won't call the recession, but we definitely are calling for a weaker economy, because when the labor market weakens, demand weakens, and if demand weakens, the economy will weaken. This is as simple as that, and that implies lower rates going down in the next few months, at least in 2025, and definitely not. We are definitely not in the camp of those who think that rates will stabilize at these levels. We don't.
Okay, okay. I definitely see what you mean there. And looking a little bit closer at inflation, if you had to put a number on where inflation is going in 2025, what would you say? Because it feels like we're in an interesting scenario. You mentioned the Fed is focusing less on inflation right now, more on employment. We're not at the 2% target just yet. People are definitely feeling inflation, I think, in
Yes.
their everyday
Yes.
lives. And we
Yeah.
have Trump coming in, lots of questions
Yeah.
about if his policies will be inflationary. So what are your thoughts there?
So uh, let's spend 2 seconds on Donald Trump and the animal spirit that he represents. He was elected. The main concern of the American people was, and the reason why they voted for Donald Trump, the main one was inflation. It wasn't immigration, it was inflation. Can you imagine a second that this animal spirit will not try to accomplish what he promised on that front? I'm one of those who truly believe that he's got this in mind, and this president and the House and Congress will try to fight inflation. Now, the actions or the promises of the actions are tend to demonstrate that those actions could trigger more inflation, which implies that maybe those actions will not be put into practice. So from wordings to action, there's a huge gap, and we think that this administration, the January administration, will definitely have in mind the fact that the American people want this administration to fight inflation, and 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 we will have this. I think that this is only time will tell, but my belief is that this administration is definitely the same as the Biden administration. They know that inflation is a main hurdle, obstacle, and they have a target that they need to achieve. Will they achieve it? They will only achieve it through a weakening economy, and we believe that we're going to have a weaker economy. And let me remind you one thing. When if we look back to the 2016, 2020 Trump mandate, he is not the one who saved the economy from the recession. In 2019, it was Jerome Powell who saved the American economy from the recession by lowering rates. So, same recipes will end up with the same results. So we do not believe that those tariffs, those aggressive positions that the new administration will put in place or will develop will end up in different results than what we had earlier in the previous presidency. So we look at the numbers. The numbers show that Trump Trump's policy from 2016 and 2020, without the intervention of the Fed, wouldn't have avoided the recession. So we're back to the initial, the core of the subject is what will the Fed do? The Fed will lower rates, I can tell you that already, when the economy is going to weaken. And the economy is bound to weaken because there are too many indications that show that the labor market is weakening, that the delinquencies, I mean, you name them. There are 10 million Americans who are now delinquent on their student loans. You have car loans delinquencies who are hitting records that we haven't seen in 15 years. So the people is suffering. The American people is suffering. And it's suffering because of inflation, maybe, but not inflation per se, but by higher prices. And Charlotte, give me 1 second to explain why higher prices are different from inflation. Because we had so much inflation that prices have reached levels that are destructive for the demand. It's not about going from a present level to a higher level. Those levels are already very restrictive and conductive of pain for the consumers. And this is exactly what is happening. It's not about inflation, it's about prices that are too high, already too high for most of the American people.
I think that's an important distinction to make. And you can really see how all the different points that you're talking about come together. So this is all important for gold in 2025. Are there any other factors outside the US maybe that you're watching when it comes to gold in this coming year?
Well, everybody, we do, but again, we know, because history is telling us that the main the key element that you have to look at is the direction of rates. Now, this being said, everybody will want to discuss about the behaviors of central banks and how are they still buying and how much are they buying gold. That's an element. The second element is, of course, people will talk to you about geopolitical risks. Are they being on the rise or not? We never believed that the geopolitical risk was a key element to forecast the direction of the price of gold. And you have, of course, the investment demand. And the investment demand is basically the second most timely ingredient to help forecast the direction of the price of gold. And if you look at those speculative positions, the long and the shorts in the gold market, you realize that the shorts are non-existent. So don't expect a support from the shorts for the price of gold in the short term because they are non-existent. And the long have been taking profits. So technically speaking, you had already a 35% correction. And ideally, we could go maybe to 50%, but this will take the price of gold to probably 2,500, 2,550, but we won't go lower than that. So non-speculative positions, the future market, the central banks, investment demand, and the direction of rates. Because remember one thing, the markets don't care about politics, they care about the economy. So we can talk about politics as much as we want, but I know for a fact that this is not a key element to that will give us a direction for the price of gold.
I think it really helps me when you put them, ranking them in that order. So I know that what is most important to you. I think that helps me understand a lot more. So this is what we should be watching for gold next year. I want to take a little bit of a closer look at the price. So when we talked last year, you'd mentioned that 2,500 level. And of course, we got past that. And at the beginning of this conversation, you're talking about getting to the 3,000 level. So is that a 2025 story for you, or how is it looking in terms of price?
Yes, for us, it's definitely a 2025 story. We think that the long-term neutral rate is not at these present levels. It is not. It's closer to 2.5%. And that implies that the Fed will be more aggressive cutting its rates. This is what it implies. And in the meantime, we will all be watching the data on the inflation front, because everybody wants to look at inflation to give us a direction, but also on the labor market. And we truly believe that the labor market will be the leading indicator for lower rates ahead of us. And we see that labor market weakening months after months on very different fronts. And on the labor market front, one more thing: you have the government employees and you have the private sector employees. And if you look at what happened to the job openings in the private sector, you see a continuous decline, quarter over quarter over quarter. Whereas on the government side, you had a more or less stable rate of openings. And this shows how the labor market would have been much weaker had the government, the public sector, not been helping those data in that significant manner. So the economy is weaker than what we think. If you look at the profitability of the, this is really not, or maybe out of subject, but it's important for the viewers to understand that the S&P 500 is not the American economy. The American economy is the 5,000 companies. And if you look at the bottom 3,000 companies, more than 40% of them are not profitable. More than 40%, versus less than 10% for the S&P 500 companies. So the economy is weaker than what we think. The labor market would have been weaker without the help of the public sector. And inflation is indeed a resilient number, but it's not because we have a little bit of inflation. We're not talking about 3.5%, 4% inflation. It's not because we have a little bit of inflation then that the economy cannot weaken, and it will probably weaken much more than what we think. But for the time being, if we look at the statistics from the that everybody's looking from the Federal Reserve of Atlanta, we are still at 3% for Q4 2024. So we'll see. Time will tell. But we are in the camp of those who think that too many numbers are showing a weakening economy that will force the Fed to lower its rates, and this will be the only factor that will help gold reach 3,000 in 2025. And it's a fairly clear picture for us. There are no hurdles to achieve this target. It's just a question of time, and the picture would be probably much clearer for everybody further down a few months down into 2025.
Yeah, it does feel like we're in a little bit of a waiting period right now. And once we get
Yes.
through the next few months, it'll start to become clear, just like you said. So I'll throw in just a small question about silver, since it came up a little bit at the beginning of our conversation. So we've got a pretty open pathway for gold to 3,000. Where do you see silver in 2025?
As you know, silver is more volatile than gold. simply because the market is much smaller than gold. And uh, and with silver, you always have this industrial factor that gold doesn't have. But basically, they go hand in hand. So if gold is going to 3,000, silver will definitely do extremely well, regardless of the demand that could be affected by a lower economy. But a lower economy implies lower rates. Lower rates imply a market turning very positive for the ahead of us, and silver will do very well. So we are extremely constructive on silver because we are constructive on gold, knowing that silver is much more volatile, and something that has really attracted my attention yesterday was the jump in shorts of the silver ETF. So, I mean, that the number of shares that were shorted in less than a month uh, was that number doubled in a month's time. So we have a ratio, a covering ratio of more than 2.5, which is not extreme, but it's violent. And we don't like violent moves. So expect more volatility, even more volatility with silver than in the past, because of those short positionings that probably will have a hard time settling at lower prices.
Okay, okay. Extra volatility for silver in
For
the next
silver.
little bit. So we'll keep an eye out for that. And before I let you go, of course, we want to take a look at the gold stocks. So at the beginning of the conversation here, you'd mentioned there's some disappointment in 2024. And I
Yes.
remember last year we were talking about gold stocks, and you mentioned we were moving from phase one, which was about strengthening the balance sheets, focusing on profitability, into phase two, which was more about growth. So how is that transition looking to you right now? What are you seeing there in terms of that?
It's definitely in motion, and it has been in motion for the last 2 years. But it's growth that is very, very well thought, that is uh, 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 that is fundamentally logical. By that I mean we are not growing for the sake of growing. We are growing in a clever way. We purchase assets that are accretive, and we are buying growth that is going to be accretive. And we don't build debt at the expense of the balance sheet. So it's very sensible, and it's a slow. It's really in the early days. I said that it's the last two years, yes, but it's slowly and very slowly picking up. So and and when you look at those gold miners, what is important is to see how they behave, in the sense that what price are they willing to pay to achieve that objective. And in their case, the price is very, very reasonable. In essence, it's accretive. So I haven't seen one M&A announcement that didn't make sense or couldn't be explained to the shareholders in a constructive way. So so far so good, but it's slow motion, and still very very shy. They are still very shy, and because they see their balance sheet growing up, but they are still very confused about the strategy that need to be implemented with that cash that is being built. So uh, uh, because they remember very well what happened in the past, and I can tell you already that 2 years down the road, those emotions they have about what to do with their cash will have disappeared completely. But we're not there yet. We're not that yet. It's really the infancy of the growth strategy that we see being implemented in the sector.
Yeah, I think you're going in the direction where people have a lot of questions, right, about the gold stocks. We've seen, of course, there's been some companies that have done well this past year, but
Yes.
people are really waiting to see those across the board gains in all the gold stocks across their
Yes.
portfolio. So, not for you, is that going to happen 2025 or that's down the road?
It is. I think it's definitely. I mean, the performance of the majors, put aside the Newmont and the Barrick, because they each had their very, very different profiles, and which affected the performance of their shares. But globally speaking, the performance of the gold miners has been extremely eclectic, extremely, and and a lot of explorers, a lot of developers have been really have had poor performances, and we had disasters, actually many disasters announced, many disappointments. Uh, so this the sector has not performed in a homogeneous way. It hasn't, and it only performs in a homogeneous way at the peak of the cycle. So for those who don't know where we stand, I can tell them already that we are not at the peak of the cycle. We are far from the peak of the cycle. And another and maybe that number of people will better grasp it. It's the profitability of the sector. Usually, the sector peaks when the readjusted net margins, the net profitable of the operations, is north of 20%. And now we're turning around 15%, 14%. So and the only way to increase the profitability, the only way is for gold to go higher. We're not there yet. So we need a higher gold price to reach a higher profitability that will be the peak of the cycle. We haven't seen this frenzy in M&A activities. Every growth strategy implemented is very reasonable. All that shows that the sector is really preparing for a better years ahead of us. But let's not say years. Let's stick to 2025 and see where we get when we get to the 3000 and how those players behave, because it's all about their behavior. Their behavior will tell us if we have reached the peak of the cycle or not. I can tell you already that until we reach 3000, I don't see any reason to get out of the sector.
Okay, I think I've got one more question before I let you go. And okay, so keeping in mind that we're not in this time yet when we have those homogenous gains all the way across the sector, we've got to do our work still right now in terms of gold. Any advice you would share for investors who are approaching the sector in 2025?
I will tell them to diversify. I will not give them, very original advice. If you are not a specialist, you diversify, because even specialists can miss some disappointments. So let's be humble, first of all. And the only way in a sector that has a 35% volatility, 35%, it's huge. So for a non-professional, I would advise diversification. That's the only way to reduce the volatility and to increase the expected return on your investment.
Okay, I think that's some really solid advice to end on heading into the new year. So thank you so much for coming on to talk about gold, markets, a little bit of silver. This was really good. Always happy to have you here.
As usual, Charlotte, it's a pleasure.
Once again, I'm Charlotte McLeod with investingnews.com, and this is Alain Corbani with Montbleu Finance.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.